Hey everyone, it's Road to Retire. Welcome back to the channel, following my journey of retiring early, and we're going to talk about my investments that I use to try and retire early. Before I get into that, 25,000 subscribers. Thank you all so much out there for making this reality of YouTube being a side hustle and making money for me. Without all of you, none of this is possible. So thank you so much for all of those who continue to follow me through my journey from the beginning of the Dividend Grinder days, and all the new subscribers through my side hustle websites and reviews. Thank you so much from the bottom of my heart. You all are awesome. So before I get into investing, just know I'm not a financial advisor. None of this is financial advice. Even though I have my accounting degree, I do not have my certified public accountant designation, and I do corporate accounting, not exactly tax accounting or personal finance accounting, if you want to talk about that. I am just sharing my journey and the investments that I do for my own unique situation, which, speaking of unique situations, here's why what I'm doing, I do not suggest all of you do, but it's something that you should know. So there's two things to note before I get into my triple portfolio strategy of retiring early. Why am I doing this? Unfortunately for me and my personal situation, it's kind of a necessity versus a luxury. A lot of people are in the FIRE movement, or at least trying to FIRE, which is financial independent, retire early. And while it's a luxury and a dream goal for most people, it's kind of a harsh reality for me that I need to retire early. Why is this? I'm 33 years old, and at age 30, I got diagnosed with polycystic kidney disease, an incurable disease with an average life expectancy of mid-60s. Now, who knows if medicine can change in the future, if I get a kidney transplant. I'm not going to get into the medical side right now, but just know that, like, if I work until 60 with a life expectancy with my disease of 65, I will be a miserable human being, and I will never be happy with my life looking back on it if I don't retire early and get out of the 9-to-5 grind, which at this point is like a 7-to-7 grind with my side hustles. So with that being said, you know, the FIRE movement, retiring early, this is something that is really hits home hard for me. It's really necessary, as I just said. So just keep that in mind, that the strategy that I use shouldn't really be for like 99% of people out there. It's very niche to my situation. So there's that side of it, the whole reason why I want to retire early, and I'm trying a method like this. The second thing that I'm going to say is the first portfolio of my triple portfolio strategy, extreme dividend. The whole point is dividends, right? Like I have many monthly dividend stocks that I'm going to be investing in my first portfolio. Keep in mind, the best thing you can do if you're a normal person, again, I'm not a financial advisor, but this is kind of common sense at this point, is just get into like a global ETF, just invest your money there for the long run. You want exposure to international. Obviously, the US stock market has been performing well for the past 100 years or whatever. So just go into index funds, keep it simple, just put your money there and, you know, let it work in the background. Don't touch it. You know, investing's like a bar of soap. The more you handle it, the smaller it gets. Same for your portfolio. So with that being said, I would never advise a normal person to have a portfolio like mine as their first portfolio, because the tax consequences are going to be insane. These are not qualified dividends. You're going to be taxed out the butt. When you use this method, I have ways of compensating for that with my day job, just adding more into the federal bucket before I even see my paycheck. So extremely tax inefficient. I would never put these holdings into like a Roth where it's tax advantaged. I would never do that strategy with dividend holdings. Just never focus on income. Just buy the market. You're not going to beat it. And the second thing besides tax inefficiencies is that this is so complex. I make it hard, like on myself. I could simplify it, but it's just the way that I'm doing things. And like I said, this is for a person who's trying to retire early, and I'm giving myself like a 12-year window for my first portfolio, and then I'll have a second one at 45 I'll get into, and then I have my common retirement portfolio. So with that being said, there's my reasonings for doing this kind of strategy. I don't advise you to follow along, but by say follow along, I mean I don't advise you to put your hard-earned money into an investment strategy like this, but it's just my journey of retiring early, and I think people like to see, you know, all that entails if you want to really live that FIRE life without, you know, having the smallest, tiniest burn rate of like a minimalist life with no possessions or anything like that. A completely normal life with a son, hopefully have 2 sons. So let's get into that. So what you're looking at right now is the first portfolio, the get your burn rate as little as possible. This is all of my monthly expenses. There's a few missing on the side here, but all of my monthly expenses. And as you can see, for ones that are definitely recurring and ones that I can kind of manage, I have a unique monthly paying dividend fund, ETF, whatever it is. I have a unique fund for each individual expense. This helps me track it better, what's coming in, and if I have over the amount. So let's say my cell phone's $20 a month, and I have JEPI, JP Morgan's S&P 500 fund that's high income, and occasionally these aren't flat dividends, they're pretty lumpy. So, I have expected to get 30 cents, but a couple months it could be 35 cents. I've seen it all the way up to 50 cents, but my baseline, my conservative estimate here is that I'll get 30 cents a month from JEPI. But like I said, sometimes it's more than that, almost up to like 75% more in some cases. So any excess that I get above my $20, I will take that excess amount and I will reinvest it back into the fund that is paying for that expense. So it's kind of like an inflation buster if prices rise on that certain item. It's also, preventing any dividend amounts that were lower than anticipated, even though all my amounts are pretty conservative here. But, if they ever get cut a little bit, I could theoretically make it up by having more shares of that holding. And, I'm not putting any more money into it. I'm just reinvesting the excess that's paying for these expenses. And as you can see, the expenses in green here, these are already covered. So I have Amazon Prime, my cell phone, my wife's cell phone, our Ring video camera subscription, and our Sam's Club subscription, which if you don't know what Sam's Club is, it's basically the Walmart version of Costco. So it's crappier, but nonetheless, I still like Sam's Club and it's cheap gas. So those 5 expenses, theoretically, if everything were to stay pretty static and conservative, those are paid for the rest of my life. And the whole point of this first portfolio of having all of these monthly payers is to get my burn rate to 0, or at least as close to 0 as possible, meaning that all of my monthly recurring expenses are covered completely by dividends. Now, as I said earlier in the video, this is a massively tax inefficient method. All of these taxes are at ordinary income rates. So if you have a high income family, if you're in a high tax bracket, this is going to be incredibly inefficient and just be a headache at the end when you go to file your taxes. But I compensate for that. Nonetheless, I want my expenses covered, and this is the way that I'm going about it. I did research on all of these positions, and while they're not like, oh my god, these are like super duper high quality, some of them are high yielder and a little more higher risk. This YMAX one, I'm just using that for Xbox because I know YMAX is a crappy fund, but nonetheless I want to see if it can pay for my Xbox. Xbox I can just do without, it's not that big of a deal, but I'm seeing if it can pay for that. So with the exception of YMAX, all of these have pretty solid, consistent dividends. Some of them are extremely flat over time and they don't cut. Some of them, like JEPI and JEPQ, JP Morgan's funds, they're lumpy, but nonetheless, on ones that are lumpy, which could be volatile in how much they give per month per share, I try to go as conservative as possible. It's like the lowest amount they paid out in like a 3 to 4 year period. Some of these are newer funds like SPYE, so they don't have much history, but they're covered called strategies, so it's not like they're going to go to 0 really quick anytime soon. They're not doing anything like sketchy. These covered calls are higher yields, a little bit higher risk, but they're nothing like, collateralized debt obligation CDO stuff that's like can get really risky, really seedy in bad financial times. Nothing crazy like that. We have stuff like UTG, which is like your Reeves utility fund. So I have utility funds. I have commercial real estate, or Stag is more industrial real estate. I have a floating rate fund here. I have preferred shares, JEPQ. I have covered calls, and I have over PDI, PIMCO's Dynamic Income Fund is more of a, they do a lot of different debt instruments to get there, but they are very consistent. They haven't cut their distributions like in forever. In fact, they've raised it over a decade that the fund's been alive and their net asset value, their NAV, has not really decreased. So I tried to make it as high yielding as possible without dipping that much quality. I don't care about appreciation for this portfolio, but at the same time, I don't want it to tank, and I'm just relying on that yield to kind of make up for that. That's what you're kind of hoping with YMAX, but for everything else here, these are pretty steady eddies over time, and you're going for the yield, not for appreciation, but you don't want that price to tank and the net asset value and the fund itself to go under. So these, in my opinion, for my situation in this high yielder monthly portfolio, are good positions to take. And that's what I'm going with. And the way that I approach it here, I have, how many shares I need for this, just tracking how many shares I have left for it. But a lot of people know what the debt snowball method is, where it's like if you have a credit card that's $500 and another credit card that has $1,500 on it, you would attack that $500 credit card as fast as possible and then turn all of your energy to the $1,500 one. I'm kind of doing that here with my dividend portfolio. I'm attacking all the small ones. And as you can see, and I just started this portfolio like 3 months ago. So the fact that all of these are already covered for theoretically the rest of my life, what dividend investors are hoping for, the fact that I have that covered is pretty awesome already. But I'm going down the line here from like least expensive to most expensive and attacking as I go along. Now, I haven't been attacking this as much as I want because I'm an idiot American who has an expensive truck to pay off. So I've been putting pretty much a huge, I would say 90% of my side hustle income just to paying off the truck as fast as possible. I'm hoping to take that 5-year loan, a $64K truck, and pay it off in 2 years. We'll see how I do with that. I'll keep everyone updated there. And then, once that truck is paid off, that side hustle income, all of it is just going to go flow right into this portfolio and get my monthly burn rate as close to zero as humanly possible without going insane. So we'll see how I do with it. Again, I don't recommend you copy this portfolio. It's just a bunch of monthly payers with higher yields. Nothing too insane. None of them besides YMAX are paying like 20% yields that are unsustainable, and the stock itself is crashing. So this is just my strategy in my first portfolio. Let's talk about my second portfolio. My second portfolio is literally just one holding, and you're looking at it on screen. Ticker symbol VIG. This is Vanguard's Dividend Appreciation Index Fund. And what is the purpose of this? This is my bridge account, as I call it. So my whole goal to retire early is to at least partially retire at age 45. Now, that's the goal. We'll see if I hit it. I am currently 33 years old. So the big part of this plan is get that first portfolio, the monthly expenses down to zero as close as possible. And then by the time I would partially retire at age 45, this is where this fund would come in. And this is, on my end, strategic, the Dividend Appreciation Index Fund. This is not high yielding at all when you first buy it. It's like 1.6 or something like that. It's pretty small. And the whole point of this fund is that it invests only in companies that appreciate their dividend over time. So theoretically, this is a yield on cost play. So you buy today, and that dividend yield might be 1.6% today, but 20 years down the line, that yield on cost could be like 5 to 6%, and you're buying a very solid ETF. As you can see, if we click on the max here, look at that chart from when did it open? 2006. It's gained like 305%. So they're on screen, 305% over time. So this is a little bit of a strategic play on my part, because when I'm 45, I could have one of two options with this fund. I could either just use it as a total market play, like 300% of all time. This is a solid capital appreciation grower, and I could just sell it when I'm 45 and then use that to supplement my part-time job at the time. Or I could take the dividend and make up for other expenses that I will need when I partially retire and work less hours. So this is the point of this. And it's not the heaviest portfolio that I focus on. It's by far the least, but I'm just throwing recurring money into this fund in the background, and I will just let it grow, and I will see when I'm 45 years old if that, if my plan comes into place nicely. When I'm 45 and want to partially retire at the very least, I will see if I want to sell this fund completely, or if I want to keep the fund, don't sell anything, and then just live off of dividends. Not live off of it, but use those dividends to supplement my income. And I say supplement, and I'm not gonna be using them entirely for my life, because the third portfolio is probably the most important. Let's get into that. The third portfolio is strictly retirement, and this is all in your traditional index funds, stuff like VT. I'm heavily into VT. I believe in global diversification. I know everyone likes to just put it in the S&P 500, all of their money, and then let the US market go. And I know the US has outperformed pretty much every single stock market index in the world out there. But nonetheless, I believe in the global aspect of it. I believe in broadly diversifying, but that's just me. It's lower volatility, and I'm putting a lot of money in there. And portfolio 3, my 401k essentially is in here, a little bit of my IRA money, but this is above and beyond my highest portfolio, my biggest dollar amount. And the second that I hit either 59.5 or 60, I'll see when I want to, take out without penalty, I am just going to cash out the entire thing and ride it out. But this portfolio is by far the most important. It needs to be the biggest amount. This is my last stopgap, if you want to call it that. I am going to be living off of that money for the rest of my life with no work income coming in. So retirement fund, this isn't just for someone like me who wants to retire early. Your 401ks, your 403bs, whatever you have out there, your IRAs, your Roth IRAs, if you can invest in those, are your most important funds. This is for pretty much every single American out there, unless you're like a real estate tycoon or something like that. But this is by far the most important piece for me to retire early, because I need to get that portfolio amount as high as possible, so I don't even have to worry about it. And I don't want to worry if somehow I do live to like my 80s or whatever. I don't want to worry about income coming in. But theoretically, my step one, or my first portfolio, my second portfolio could make up, some of that legwork, where theoretically, if I could, boost my side hustles to an amazing amount or something, theoretically, I could live off the first and second portfolios, but I still want that huge backbone in my third portfolio, my 401k especially. This is where I contribute about 15 to 20% of my income before even touching my first and second portfolio. So this is above and beyond where my main focus is. And, worst case scenario, God forbid if something were to happen to me before I'm 60, I can pass this account on to my wife and my children. So that is very important to me. So all in all, there is nothing wrong if you have a goal similar to mine of retiring early, getting really heavy into that traditional 401k plan. There's nothing wrong with it. It's a good strategy all around, especially if you have a family for that purpose. So this has been a long investing video. I can go more into depth into investing. I love talking about dividend funds, even though I believe they're highly tax inefficient and most people should not be investing that way, like for the purpose of yield chasing or whatever. But I love talking about it. And if you're interested in me talking about more dividend funds, maybe you're interested in specific dividend funds that I have in my monthly portfolio, my first portfolio that I talked about, let me know. I'm willing to cover all of that stuff. I hope you enjoy following my journey to try and retire early. I will talk about side hustles again, I promise. I do want to cover the whole app in the crowd gen transition, and am I still making money off of UHRS? I'll definitely get into that. But I hope you enjoy this type of content. Let me know if you want to see more of this type of content where I get into the portfolio, I show my values and whatnot. If you're into that, I will absolutely do that. Thank you so much for making 25,000 subscribers reality. And, hopefully we can hit 50,000 subscribers in about a year or two. So that's the dream goal. We'll see. Thank you so much for watching Road to Retire. See everyone in the next video.